Okay, so this is video 2 in a two-part video series covering domestic LLCs and 1065 reporting. So the first video, I outlined how you could have situations where you have a U.S. entity, an LLC that's a partnership, and the entity is not subject to tax in the United States. If you haven't seen that video already, I'd recommend watching that first. I'll leave a link below. And then in this video, we're going to cover how to actually complete the 1065 if your LLC qualifies for this no U.S. tax treatment. So I've got 4 slides in front of us outlining the fact pattern again and the rules here, and then a sample 1065 where you have a scenario where you have a U.S. LLC filing a 1065, but the entity is not engaged in trade or business in the U.S. and has no U.S. source ECI. Okay, so if we go back to the slides here, this is the fact pattern we were working with in the previous video. So we have Consulting Partnership LLC, it's a Delaware entity. The LLC is a marketing consulting agency, and it's owned by 3 individuals. So we've got John, he's a U.S. citizen, but he lives and works full-time in Germany, right? So John's an expat. Jane Washington, she is a Cayman Islands citizen, and she lives and works full-time from the Caymans. And then we have Emily here. She is a citizen of Argentina, and she lives and works full-time from Argentina. Now, the LLC exclusively operates from outside the United States. It doesn't have any U.S.-based employees, offices, no U.S. dependent agents, and no owners that are physically based in the U.S. and working from the U.S., right? These 3 owners all work exclusively from their homes in the foreign countries, and none of them need to travel to the U.S. to complete any work, right? Everything is done from outside the U.S. So the position they're taking is that the LLC is not engaged in U.S. trade or business, and it doesn't generate any U.S. source ECI. Now, the reason for the 1065 reporting, even though you don't have a U.S. TOB and no U.S. ECI, is under the Treasury regs and the Internal Revenue Code, every domestic partnership must file a return of partnership income, right? So in this case, we have a U.S. LLC. It's a multi-member LLC, so that's treated as a partnership for federal tax purposes, and it's domestic because it's a U.S. entity. It does not matter that the entity operates exclusively from outside the U.S. It doesn't matter that it has owners that are all based outside the U.S. It doesn't matter that all the income is going to be foreign source income. It's still a domestic entity for purposes of the Form 1065 filing requirements. So it's got to file it. So before we jump into looking at the actual 1065 example, I wanted to cover some of the top mistakes that I see made for LLCs in this context. So the first one is just a flat-out failure to file the 1065 each year. Again, so the LLC, multi-member LLC, is a domestic partnership regardless of what's going on inside of it, right? So it doesn't matter whether or not it's engaged in U.S. trade or business, has any U.S. source income, foreign or U.S. partners. All of those elements are relevant to how we complete the return, but it doesn't mean that it doesn't have to file a 1065 because everything's done in a foreign country. It's still a domestic partnership, so it's got to file. So that's the mistaken presumption I see is that, well, if the LLC has no U.S. income, no U.S. owners, we just don't have to file at all because it's a moot point. And that's just not the standard, right? The IRS still wants to see the return every year, so you've got to file a 1065. The second mistake I see made often is that the 1065 is filed, but it's effectively blank, right? So they don't report any income or expense fields. Here's the big problem with that. So nowhere in the code or the regs and the instructions does it say you're only reporting U.S. source income and expenses, right? The standard is report gross income and expenses, period, right? Whether it's U.S. or foreign. So what I mean is if we look at a 1065, what I've seen done is the entity completes the name of the partnership, the type of activity, EIN, right? All this looks good. But then when we get down here to the income and deductions section, all of this is blank. Even though the company does have gross income and it does have expenses of these various categories, they filed it with a blank return and then ultimately blank K-1s under the notion that, well, if there's not going to be any U.S. tax, why does it matter? So I'll just leave it blank. That's not right. Okay, you've got to complete this reporting the gross amounts of income and expenses, whether they're U.S. or foreign. You've got to report everything. Okay. The second issue, and this kind of goes hand in hand with the second point number 2 here. Point 3 is when you file a 1065, you don't distinguish between what is U.S. versus what's foreign source income. So if we look at the 1065, report the gross amounts up here, right? And then if you have foreign source income and foreign source expenses that are in connection with that income, the line 16 items in Schedule K is where you break out those amounts, right? So line 16 on Schedule K, right, partners distributive share items, we have the foreign transactions here. This is where you communicate to the IRS and to the partners, the recipient of the K-1s, that you have foreign source income and expenses in connection with that foreign source income. So I'll come back to this later, but this is also the issue I see is sometimes the partnership return does have amounts reported on page 1, but they fail to adequately categorize them as foreign here in line 16. So line 16 will be blank, but page 1 will have information. That's another big mistake. And then lastly here, filing the 1065 but not accurately reporting the number of foreign partners. So if you look at the 1065 return, there is a question. So in Schedule B, it's question 14 for the 2020 forms. But it asks, does the partnership have any foreign partners? If yes, enter the number of 8805s. So in this case, yes, we're going to have foreign partners, so we check yes. But because we have no U.S. source ECI, because we're not engaged in trade or business, we enter 0 here, right? We're not attaching any 8805s. What I see done incorrectly is, even in cases where they have foreign partners, they check no because they don't feel comfortable or think it's wrong to put a 0 in here, right? So, if you have no foreign partners, you would enter no. But if you do have foreign partners, it's okay to check yes. You want to answer that question accurately. And then if you have no U.S. source ECI, then you don't need to file an 8805. So it's okay to put 0. Okay, so that's another big mistake I see made is either answering this no when you do in fact have foreign partners, or answering yes and then leaving this blank. You want to make it clear that you have 0 8805s going along with this return. Okay, so that covers some of the top mistakes. Let's look into the fact pattern and some of the income information, and then we'll go back to the 1065. Okay, so let's look at what income and expenses are generated in this entity. Well, the LLC generated $175,000 in gross receipts from marketing consulting services, and it had $22,200 in expenses connected with those services. Now, again, if we're going with this fact pattern, then no U.S. TOB, no U.S. source ECI, all of this activity is going to be foreign source, right? So all the income is foreign source because all of the tasks are completed by the owners and employees who are physically outside of the U.S. So, okay, so let's look at the first paragraph there and how that's reported. So if we go to page 1, again, reporting gross amounts here. So it's all foreign source, it still gets reported here. So we have our gross receipts of $175, and then we have the expenses reported down here, rent, other deductions totaling $22,220. And so our net ordinary business income or loss is going to be $152,780. Okay? And then ultimately that amount flows through to Schedule K, line item 1, right? So $152,780 is what's going to be allocated across the 3 partners in proportion to their ownership percentages. Okay, so second paragraph. The LLC has 2 bank accounts, right? So one's a U.S. account, and then they have a Cayman Islands bank account. So why is this important? Well, because the U.S. bank account generated $10 of interest during the year, and then the Cayman Islands bank account generated $40 of interest. So if I go back to the 1065, let's look at the balance sheet here. So the balance sheet, we've got a cash account, $192,830 at the end of the year. So what we're saying is that within this $192,830, they have a couple of bank accounts, one of which is in the U.S., the other one is in Cayman, and they had some interest income earned on those accounts. Interest is a separately stated item, so it's not included in line 1. It's separately stated on line 5, right? So $50 in total interest income. If we flip back just to rehash what the breakout is, so we have $10 of interest is going to be U.S. source income because it's coming from a U.S. account. And then they've got $40 of bank interest from Cayman is going to be foreign source income. So on Schedule K, we have $50 of total interest income, 40 of which is foreign, 10 of which is going to be U.S. source. Now, why is that distinction important? Because it drives how we complete line 16 items, right? So the foreign transaction amounts. So if we look at this line 16, name of country or U.S. possession where we're generating this income. In this case, we're sourcing it to several countries, right? Because each partner lives in a different country and they're doing work there. So we have various types of foreign countries that are generating this foreign source income. The gross income from all sources is just that. It's our total gross receipts, right? So our total gross receipts is $175,050. How do we get that number? Well, it's the $175,000 in total gross receipts from page 1, so 175, and then we have $50 of interest. So the total gross income from all sources is 175,050. Now, here's where we break out that total between U.S. and foreign source, right? Passive category income. This is the passive type of income that is foreign source. That's the Cayman Islands bank interest. And then general category is that page 1, ordinary gross receipts, 175. So you notice here we have 175,000 in gross foreign receipts from the ordinary trade or business elements, and then we have 40 from the interest. We're leaving out the 10 because that $10 of U.S. source interest is not foreign, so it wouldn't be included in here. Then in lines 16 M and N, we indicate what types of expenses are connected with these foreign source earnings. So in this case, we have general category expenses. That's the total amount of expenses. Remember on page 1, 22,200. Those are all going to be foreign source, all foreign in that they're connected to the foreign source earnings here. Okay, so if we look at a Schedule K1, let me flip down to John's K1 just to illustrate this point. So here, this is what's important for John and the other partners to know, is that, okay, I've got some income being allocated to me up here on line 1, but then when I need to decide is this U.S. or foreign source, I can see the breakout here in line 16, right? I've got total gross income here, the amount of foreign source, that's passive category, the amount of foreign source, that general category, and then the allocation of the expenses. Okay, and so this is really, really important information because it does two things. One, it communicates to the IRS that we've got gross income running through this company, but all of it is foreign source, right, except for that little bit of interest. Really important because that also further communicates to the IRS why we're not treating any of this as U.S. source ECI, because it's all foreign. And then also it's good for the reader of the K1, right? So the recipient to know that, okay, I've got ordinary income flowing through here, their allocation of the 152,780, but the breakout is all from foreign source activities of the LLC, okay? Now, why is it so important that gross amounts are reported on the 1065 and the K1s? And this is because the partnerships are fiscally transparent, right? So the partners are ultimately responsible for reporting their income and paying any taxes due. So even though this entity is not doing any withholding, it's not treating any of this as U.S. source ECI connected with a U.S. trade or business, it wants to provide all the information to its partners, and then the partners figure out whether or not they've got to do anything with it. And so in this fact pattern, this illustrates clearly why you can't leave these forms blank. So if we look at the first structure here, this is the one that we've got in front of us with the 1065 and the K1s. We've got our three partners here, right? So the US LLC, again, it's treated as a US partnership, not engaged in US trade or business, no US source ECI. but it still needs to file a 1065. So it gives a K1 to Emily, it gives a K1 to Jane, and it gives a K1 to John. Now Emily, she's a non-resident for U.S. tax purposes. Because her K1 shows that the US LLC is not engaged in trade or business, it does not have US source ECI, Emily is not subject to tax on the income being allocated to her. So she does not need to file a 1040-NR. The same goes for Jane, right? Jane is a non-resident. She's being allocated income from a US entity. It's a domestic entity, but the K1 shows that it's all foreign source income. There's no U.S. source ECI. Jane doesn't have to do anything. Now here's where it gets a little trickier for him. John's allocation of income from the K1 is still necessary for him because he has to file a tax return as a U.S. citizen. So John's a U.S. citizen. He lives in Germany. He's got to file a 1040 every year and report his allocation of income from the partnership, and he pays tax on those earnings. And that's because U.S. citizens are subject to tax on their worldwide income from whatever source derived. So in this example here, what we've done is we've shown that, yes, the US LLC isn't subject to tax directly. It's providing K1s that allocate income to 3 partners. These 2 partners are getting allocated income and not subject to any tax because there's no US TOB and no US source ECI. But even though that's true, John still has to report his allocation of the income and pay taxes. And so this is why it's so important that the 1065s are completed with showing information, because you never know necessarily what partner might actually have to report the income and pay tax directly anyway, even though there's no withholding done at this level. So like for, I guess, maybe a simpler example, let's say you take John out of this mix and you have a 1065 and K1s just for Emily and Jane, and you leave them blank. You're thinking, okay, well, this is all right because they're blank K1s. Emily and Jane don't have to report any income. And that's true, but the reporting requirement exists that you report all income and expense regardless of source because of this type of fact pattern. You could have John in here and he needs to get a K1 with information on it so he can accurately prepare his return. Right? So if we look at the 1065 for John, or his K1, I mean, imagine John getting a K1 that had no numbers on it. So he's an owner and he's got no numbers on this return because the preparer said, well, this is an LLC with no US TOB and no US source ECI, so I just left everything blank. Well, that does him no good, right? Because he's got to understand what allocation of income he has so he can accurately prepare his 1040. So let's look at the second fact pattern, which illustrates this point a little further. So we have very similar structure here. We've got Emily and Jane, the same LLC, but instead of John holding it directly, he's got an intermediary Bermuda company in here. So the partner here, 40% owner, Jane's a 30% owner, Emily's a 30% owner. These are all foreign persons, right? So Emily completes a W-8 provides it to the LLC. Jane completes a W-8 provides it to the LLC. And JS Holdings is a foreign corporation. It completes a W-8 and provides that to the US LLC. So now the US LLC is again preparing a 1065 and it prepares a K1 for each foreign partner. No US TOB, no US source ECI. But it needs to make sure it's reporting the gross income and expenses and reporting the net allocation to each partner. Do not assume that because you have all foreign partners, you can leave the K1s blank. And this is a classic example of that because what we have here is a foreign corporation, but it's owned by a U.S. citizen. The U.S. citizen ownership makes this a CFC, which means that John, when he's filing his 1040, needs to include a 5471 for his 100% ownership of the entity. And so when John goes to complete his 5471, if, again, he found himself in a position where the LLC here just prepared a 1065 and gave him a blank K1, he wouldn't be able to accurately prepare his return, right? He'd be going to prepare the 5471 and asking, well, wait a minute, how much income was I actually allocated from this partnership? My K1 shows zeros. It's blank. that does him no good, right? He needs a K-1 that shows his allocation of the income, because ultimately he's going to be a U.S. taxpayer. So that's the real important message here, because I've seen this done so many times just incorrectly. This point here, filing the 1065 but leaving all the gross income and expense fields blank. Do not do that, right? If you have a 1065, a domestic partnership, and there's no U.S. TOB and there's no U.S. source ECI, you still need to report all the income and expense, give each partner a K-1, regardless of whether they tell you they're U.S. or foreign, because you could have a situation like this again. You have a foreign corporation with an allocation of no U.S. TOB, no ECI income. If you assume that, well, there's no tax liability at this level, that's wrong, right? Because we don't know who the ownership might be. So the main takeaway here is make sure that you file a 1065 in its entirety, report the difference of U.S. versus foreign source income, and give every single partner a K-1, right? So John gets a K-1 with his allocation of the income. The other partners here, so we have Jane Washington. She's the Cayman Islands person. She's a member manager. She's foreign. She actively participates in the business. She doesn't have an ITIN or SSN, so you can use foreign U.S. as the placeholder. She still needs a K-1 with all of these income items allocated on it, right? So we show, her capital contributed during the year, her allocation of the book income or loss, withdrawals, and the pieces here that are going to be non-U.S. as well. Complete the K-1s and the Form 1065, even though that there's no U.S. TRB and no U.S. source ECI. Now, in addition to the K-1, I also would attach another explanatory statement to the return and the K-1s that outline that we're taking the position there's no U.S. trade or business, so no U.S. source ECI. Now, what's unique about 2020 is the format has changed a lot. So I'll have to update this video, because now the line 16 items are going to be communicated on Schedule K2 and Schedule K3. So I'll have to do a follow-up for that. But this type of reporting here on the line 16 items, where you put the foreign items here, this will work for 2020 tax returns going back many years. It's only the 2021 returns where they have updated the Schedule K to add different reporting regimes for these foreign source pieces. Okay, so that covers it for this video. I hope that was helpful. If you have any questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.